Welcome to the Explainer. Today we're diving into a really crucial part of the new Income Tax Act 2025, Section 36. Now, think of this section as the ultimate gatekeeper for your business expenses. If you get it right, you're compliant. But if you get it wrong, well, it could cost you, and cost you big. Understanding this is absolutely essential for every single tax professional and business owner out there.
So let's start with a question. Imagine a company pays the CEO's nephew a 50 lakh rupee salary for what's basically a simple data entry job. Could they just deduct that whole amount from their profits? Well, it's not quite that simple. You see, scenarios just like this are exactly what the tax law is designed to scrutinize. It's all about fairness, making sure expenses are legitimate and reasonable, and ultimately protecting the country's tax base.
And this is precisely where Section 36 of the Income Tax Act 2025 steps in. The best way to think about it is like a set of guardrails on a highway. It's designed to keep business expense claims on the street and narrow, making sure they're legitimate, they're fair, and they're transparent.
Okay, so let's get into it. Here's what we're going to cover. We'll start with the core purpose of this section, what it's really all about. Then we'll look at the rules for payments to relatives and payments in cash. We'll also explore the slightly tricky concept of deemed income, and then we'll wrap up with some practical compliance tips and the key things you really need to remember.
So first things first, let's really get to the heart of Section 36. What is this provision actually trying to achieve within the new act? What's its fundamental objective?
Right, here's the most important thing to grasp about Section 36. It has an overriding effect. Think of it like a final checkpoint. An expense might look perfectly valid under other parts of the law, but if it doesn't pass the specific tests laid out in Section 36, it gets thrown out. It truly is the ultimate gatekeeper for these types of payments.
Okay, let's move on to our first guardrail, which you'll find in Section 36, subsection 3. This one deals with payments made to relatives and other associated persons, which, as you can imagine, is a pretty common area of scrutiny for tax authorities.
This is all about substance over form. It's not enough to just have an invoice. The real question is whether the amount you paid is justified by the fair market value of the goods or services you actually received. And remember, the burden of proof to justify that expense, it lies squarely with you, the taxpayer. So, who exactly are these specified persons? As you can see, the definition is incredibly broad. We're not just talking about your immediate family. It extends out to the directors of your company and their relatives, partners in your firm, and even other companies where you might hold a significant stake. You see, this wide net is there for a reason, to scrutinize any transaction that isn't at arm's length.
Next up, we have a rule that has a massive impact on day-to-day business operations. This is the disallowance for large cash payments, which is laid out in Section 36, subsection 4. Here's the number that every single business owner needs to burn into their memory: 10,000 rupees. If you make a single payment for an expense that's over this amount in cash, the consequence is severe. We're talking a 100% disallowance. And let me be perfectly clear, that's not a penalty on a part of it. The entire expense is disallowed from your profits. And this really shows you the government's consistent push towards a documented digital economy. The why behind this rule is so important. It's about curbing the cash economy, increasing transparency, and creating a crystal clear audit trail for every transaction. It just makes tax evasion that much harder. Now for a really fascinating and frankly, often misunderstood concept under Section 36, subsection 5. This is about how an expense that was correctly allowed in a past year can suddenly become taxable income in a future year. Sounds strange, right? Let's break it down. Basically, the whole point here is to make sure you don't get a double benefit. You can't get a tax deduction for an expense you ultimately never had to pay. So if a creditor decides to waive a liability, or you get a refund for an expense you already deducted, the law says you have to reverse that tax benefit by treating that amount as income. Let's just walk through this timeline. In the tax year 2026-27, a genuine expense of 50,000 rupees is booked and deducted. Everything is fine. But then, 2 years later, the creditor waives that liability. In that same year, 2028-29, that 50,000 rupees gets added back to the business's income and is taxed accordingly. Simple as that. Okay, theory is one thing, but let's see how all of this comes together in a practical, real-world scenario. How does not following Section 36 actually affect a company's bottom line? This table is incredibly revealing. Have a look. Acme Innovations paid the director's son 10 lakhs. but the officer found the fair market rate was only 4 lakhs. So 6 lakhs are disallowed. They also made a 25,000 rupee cash payment to a supplier, which is over the limit, so that's fully disallowed. Now look at the result. Their taxable profit jumps from under 25 lakhs all the way up to 31 lakhs. That is a direct and very significant financial hit. So how could they have avoided this? Well, it all comes down to one thing: meticulous documentation. This isn't optional, folks. To defend your claims, you need a robust paper trail for every single expense. And this is especially true for payments to those specified persons, where you absolutely must be ready to justify the fair market value with clear, hard evidence. And please, pay close attention to these common red flags. Tax officers are specifically trained to look for things like splitting a big payment into smaller cash chunks just to stay under that 10,000 rupee limit. That's going to get disallowed. Missing documentation for a payment to a relative, that's an immediate trigger for scrutiny. And forgetting to reverse a waived liability, that's not just an oversight. The department sees that as undeclared income, and it can lead to penalties. Proactive awareness is your only real defense. All right, we've covered a lot of ground. Let's quickly boil this all down and summarize the most important points from our deep dive into Section 36.
Let's boil this all down to a few key principles. First, be reasonable with your expenses, especially with related parties. Second, document everything meticulously. Third, go digital for all payments over 10,000 rupees. And finally, stay vigilant about reversing old liabilities that are no longer payable. Mastering these principles is absolutely key to navigating your business expense deductions successfully.
And that's our deep dive into Section 36. We really hope this breakdown helps you navigate these provisions with a lot more confidence. If you found this explainer valuable, please do like and share it with your colleagues, and of course, subscribe for more deep dives into the new Tax Act. And finally, our standard disclaimer. Remember, this is for educational purposes only. Tax laws can be complex and are subject to change, so always consult a qualified professional for advice specific to your unique circumstances.